Is debt always bad? This is the question that quietly haunts the mind of every person who has ever borrowed money. In the quiet moments before sleep comes, perhaps you lie awake in the darkness, wondering if the money you owe will ever be truly repaid. In the vastness of human history, the concept of borrowing has existed for thousands of years, long before written law, long before the modern banking system, long before the plastic card in your wallet. Debt, in its simplest form, is merely a promise, a contract between two people, one who has something now and one who will have it later. Yet somehow, in our contemporary world, the word itself has become synonymous with failure, with recklessness, with financial doom. But what if I told you that this understanding is only partially true? What if debt could be a tool, a sophisticated instrument, not for destruction, but for the careful, methodical building of wealth? This journey we are about to take together, through the fog of financial complexity, will reveal something that many people never discover. The distinction between good debt and bad debt is not about the money itself, but about what that money does for you, where it goes, how it grows, and what it returns. As you settle deeper into this exploration, allow your mind to drift away from the anxieties of your own financial situation and into the cool, intellectual waters of economic history, of American financial culture, of the subtle art of building prosperity through understanding the difference between borrowing wisely and borrowing poorly. If these questions are bringing you some peace, you might choose to quietly subscribe so we can explore more forgotten paths of financial wisdom together. Tomorrow night, the night after that, and the night after that. For now, let us journey back to where it all began, thousands of years ago, in the ancient civilization of Mesopotamia, in the region between the Tigris and Euphrates rivers, where the very first cities were born. There existed a practice that would eventually shape the entire world: borrowing. The earliest records of debt come from clay tablets discovered in the ruins of Babylon and Ur. These tablets, written in cuneiform, the ancient wedge-shaped script, document transactions of grain, of livestock, of precious metals. One person would lend to another person with the understanding that repayment would come in the future. The tablets were not kind. They were not forgiving. If you borrowed grain during a time of plenty, you were expected to return that grain when times became scarce. If you could not return it, consequences were severe. Your land might be taken. Your family might be enslaved. Your honor in the community would be permanently stained. This early form of debt was transactional. It was personal. It was often cruel, yet it served a purpose. It allowed the borrower to smooth over the rough places in life, to survive a bad harvest, to invest in tools or animals that would increase their productivity. Over time, the concept of debt evolved. In ancient Greece and Rome, philosophers debated the morality of lending. The Torah and the Bible contained strict rules about how debts should be handled. There were even Jubilee years, every 50 years, when all debts were forgiven, all slaves were freed, all land was returned to its original owners. The idea being that no one should be permanently enslaved by the mistakes of their past, to the loans that they could not repay. This ancient compassion, this recognition that debt could trap a person forever, has been largely forgotten in our modern age, yet the wisdom remains, somewhere, in the dust of history books and forgotten scrolls. Now let your thoughts drift as we move forward through centuries of change. The Middle Ages, a period often called dark, though perhaps not for the reasons you might think. It was during this era that the concept of banking truly began to take shape. in the Italian city-states, particularly Florence, particularly Venice, merchant families, with names like the Medici, the Fugger, the Bodri, began to function. As more than merchants, they became lenders, they became money changers, they became bankers. In the truest sense, the process was gradual, almost imperceptible. A merchant would buy cloth in one city, at one price. He would travel, slowly, over dusty roads, over dangerous mountain passes, over treacherous seas, to sell that cloth in another city, at a higher price. The difference in price was the profit, the markup, the reward for risk. But what if, instead of traveling himself, the merchant could send a letter? A piece of parchment, with his seal upon it, his mark of authenticity, to a trusted associate, in a distant city. The letter would say, "Pay the bearer of this letter a certain amount of gold, and I will repay you." In Florence, or Venice, or Antwerp, this letter of credit was the ancestor of the modern check, of the modern bank transfer, of the modern wire. It was revolutionary because it allowed money to move without the physical danger of transport, but more importantly, it allowed debt to be formalized, to be recorded, to be traded. A merchant could now borrow money, not from a neighbor, but from a distant banker, whom he might never meet. The interest rates were often quite high, 20%, 30%, 40%, because the risk was considerable. A ship might sink, a debtor might disappear, a war might disrupt trade routes. Yet slowly, across generations, these banking families built fortunes. They financed kingdoms, they financed wars, they financed the very exploration that would eventually lead to the discovery of the Americas. And as the centuries turned, the concept of debt became institutionalized, became legitimized, became almost respectable. When the colonists arrived in North America in the early 1600s, they brought with them not just ships and supplies, but also a deep, fundamental understanding of credit and debt. The earliest settlers were often not wealthy. They were farmers, tradespeople, indentured servants, people who had to borrow simply to survive, to purchase land, to purchase tools, to purchase seeds, to wait for the first harvest. The colonial merchants and larger landowners quickly filled the role of lender. The relationship was often paternalistic. A wealthy merchant would extend credit to a farmer. The farmer would repay in goods, in crops, in labor. There was a social dimension, an obligation that went beyond the mere dollars and cents of the transaction. Yet even in these early times, the distinction began to emerge between debt taken on to build something, to invest in a farm, to start a trade, and debt taken on to merely consume, to purchase goods that provided no lasting value. To borrow money for a coat that would wear out was viewed differently than borrowing money for seeds that would grow into a harvest that would feed your family for years to come. As America grew, as the colonies became state, as the nation expanded westward, debt became essential, fundamental, woven into the very fabric of American society. The Louisiana Purchase, financed by debt. The great railroads of the 19th century, financed by debt. The canals, the roads, the infrastructure that would transform a raw wilderness into a beacon of prosperity, all of it financed by debt. So from the very beginning, America was a nation built on borrowed money, built on the belief that you could borrow today to create tomorrow, and this belief, this fundamental optimism, would shape the entire American approach to debt forever. In the early 20th century, America faced a choice, a crucial decision that would ripple through time, all the way to today. The question was simple: and yet complex. Should education be free? Or should it be purchased? As a commodity? Like a coat, or a pair of shoes? For most of history, education was the privilege of the wealthy. If you were born to a poor family, you received no formal schooling. You learned a trade from your father or from an apprenticeship. If you were born wealthy, you attended the best schools, the best universities. You had access to knowledge, and through knowledge, to power. But America, with its democratic ideals, began to imagine something different. What if education could be available to everyone? What if a poor boy from a farming family could attend university? If he were talented enough, if he worked hard enough to make this vision real, costs arose. Universities needed buildings, teachers, equipment. The costs were substantial, and most families could not afford them. So the solution emerged. The government would help pay through a system of student loans. The logic was elegant, simple, and at the time, quite beautiful. Education is an investment in human capital. A student who borrows money to attend university will earn more over a lifetime than a student who does not attend. The extra earnings will be sufficient to repay the debt with interest and still have more financial security for the rest of their life. This made sense. This still makes sense. On paper, at least. A student borrows money, let us say, $20,000, to attend university. The student studies, works hard, graduates, finds a job, earning perhaps $40,000 per year, more than they would earn without the degree. Over 40 years of work, the additional earnings from that degree might total $800,000 or more. So repaying the $20,000 debt is a small price for $800,000 in additional lifetime earnings, or so the theory went, and in many cases, this theory remained true. A teacher, a nurse, an engineer could borrow money for education and repay it comfortably over time, yet the cost of education has grown, risen, climbed, year after year, in ways that no one predicted, and this good debt, this investment in self, has slowly, quietly, become something else, something heavier, something more burdensome. We will return to this later, but for now, understand this. Student loans were created with noble intentions to democratize education, to allow anyone to invest in themselves. The question of whether they have succeeded remains open, still waiting for an answer. A house, a home, place where a family gathers around a dinner table, where children are born, where memories are made, where holidays are celebrated. The home is the cornerstone of the American dream. For generations, this dream was reserved for the wealthy, for the merchant class, for those who could afford to pay cash, to own the land outright, without debt, without obligation. But in the 20th century, something changed. The government recognized that home ownership was not merely a luxury, it was fundamental to the stability of society, to the prosperity of the nation. So a system emerged, the mortgage, from the French words, mort meaning death, and gage meaning pledge, a death pledge, a pledge that would end when the debt was paid, or when the house was taken away. The mortgage was revolutionary because it allowed an ordinary person to borrow a vast sum of money to purchase a house, with the house itself as collateral. The bank would give you perhaps $100,000 with the understanding that the house would serve as security. If you could not repay, the bank could take it back. This was different from other forms of debt. The money you borrowed did not disappear. It did not vanish into consumption. It transformed into an asset that would increase in value over time. Generally speaking, a house purchased 30 years ago for $100,000 is worth far more today, perhaps $300,000 or more. So the homeowner not only lives in the house, not only creates memories there, but also builds equity, builds wealth. The monthly mortgage payment is not merely paying off debt, it is building ownership, it is accumulating assets, and this fundamental truth made mortgages different, made them good debt. In the eyes of economists, in the eyes of financial advisors, in the eyes of society, a young couple borrows $400,000 for a house. Over 30 years, they pay approximately $720,000 in principal and interest. That means $320,000 in interest. Seems like a lot. Seems like they are losing. But what if during those 30 years, the house increases in value to $800,000? Then the couple has built $400,000 in net wealth beyond the interest they paid. They have also built the memories, raised their children, watched their families grow, and had a stable place to live for 30 years. So the comparison is not simply principal and interest. It is more complex. It is about building equity, building stability, building wealth over time. A house, a home, place where a family gathers around a dinner table, where children are born, where memories are made, where holidays are celebrated. The home is the cornerstone of the American dream. For generations, this dream was reserved for the wealthy, for the merchant class, for those who could afford to pay cash, to own the land outright, without debt, without obligation. But in the 20th century, something changed. The government recognized that home ownership was not merely a luxury, it was fundamental to the stability of society, to the prosperity of the nation. So a system emerged, the mortgage, from the French words mort meaning death, and gage meaning pledge, a death pledge, a pledge that would end when the debt was paid, or when the house was taken away. The mortgage was revolutionary because it allowed an ordinary person to borrow a vast sum of money to purchase a house. With the house itself as collateral, the bank would give you perhaps $100,000 with the understanding that the house would serve as security. If you could not repay, the bank could take it back. This was different from other forms of debt. The money you borrowed did not disappear. It did not vanish into consumption. It transformed into an asset that would increase in value over time. Generally speaking, a house purchased 30 years ago for $100,000 is worth far more today, perhaps $300,000 or more. So the homeowner not only lives in the house, not only creates memories there, but also builds equity, builds wealth. The monthly mortgage payment is not merely paying off debt, it is building ownership, it is accumulating assets, and this fundamental truth made mortgages different, made them good debt. In the eyes of economists, in the eyes of financial advisors, in the eyes of society, a young couple borrows $400,000 for a house. Over 30 years, they pay approximately $720,000 in principal and interest. That means $320,000 in interest. Seems like a lot. Seems like they are losing. But what if during those 30 years, the house increases in value to $800,000? Then the couple has built $400,000 in net wealth beyond the interest they paid. They have also built the memories, raised their children, watched their families grow, and had a stable place to live for 30 years. So the comparison is not simply principal and interest. It is more complex. It is about building equity, building stability, building wealth over time. Imagine a small rectangular piece of plastic, about the size of a library card, a playing card, thin, light, innocuous. This card sits in your wallet, and it whispers to you a seductive promise: buy now, pay later. What could be more appealing? What could seem more reasonable? More fair? In the moment, when you want something, when you see something beautiful, something useful, something that would bring you joy, you could have it immediately, without waiting, without saving, without patience. You simply swipe the card, and it is yours. The credit card was invented in the middle of the 20th century. Initially, it was a luxury reserved for the wealthy, for traveling businessmen who needed convenience, who needed to maintain a reputation, who needed to show status, but gradually democratized, made available to the masses. Credit card companies found that they did not need wealthy clientele. They needed millions of ordinary people spending small amounts regularly. The mathematics were beautiful from the credit card company's perspective. If 1 million people carried balances and paid 18% interest, the profits would be extraordinary, immense, staggering. So credit card companies began a marketing campaign that was perhaps the most successful marketing campaign in human history. They advertised not the debt, but the freedom, the convenience, the rewards, the points, the cashback, the miles. You could fly for free. If you used the card, you could buy things and earn points that converted into prizes. The narrative was rewritten. It was no longer debt. It was a financial tool, a savvy choice, a way to get value, to get rewards for spending money. That is the genius of the credit card marketing. It has hidden the fundamental truth, which is that you are paying for the privilege of borrowing, often at very high rate. Credit card interest rate average around 15% annually. Some are higher, some are lower, but the average is 15. Compare this to a home mortgage at 4% or 5%. Compare this to a car loan at 5% or 6%. Compare this to a student loan at 5% or 6%. The credit card demands interest rates that are 2 to 3 times higher than these other forms of debt. Why? Because credit card debt is unsecured. There is no collateral, no house, no car, no degree, no asset that backs the debt. If you cannot repay, the credit card company cannot take your house, cannot take your car. They can only call you, send letters, damage your credit score. So they charge higher interest rates to compensate for the higher risk. But here is the critical problem, the dangerous truth. Credit card debt is often used for consumption, for pleasure, for things that decrease in value. You borrow $1,000. You buy a television, a set of clothes, a vacation. You enjoy these things. They bring you happiness, or at least they seem to. But the happiness fade. The television becomes an old television. The clothes become last season's fashions. The vacation is a memory, and yet the debt remains. The interest compounds. If you only pay the minimum payment, often only 2% of your balance, your $1,000 purchase might cost you $2,000. By the time you pay it off, you have paid 100% in interest for something that no longer brings you joy, that has no lasting value, that has decreased in value since the day you purchased it. There is a cycle, a pattern, that repeats in the lives of many people. It begins. Innocently enough, a credit card arrives. In the mail, a piece of plastic, offering convenience, offering rewards, offering freedom. The new cardholder uses it cautiously. At first, buys groceries, pays rent, makes the minimum payment on time. Each month, the credit card company is pleased. The cardholder is pleased. Life continues. But then, something happens. An unexpected expense. A medical bill. A car repair. Something urgent. Something that cannot be delayed. The cardholder does not have cash, does not have savings, so they use the credit card. They tell themselves, it is temporary, a bridge, until the next paycheck. But the next paycheck comes, and there is still not enough. There are still obligations, other bills, rent, utilities, food, insurance. So the payment on the credit card is made, but it is less than the interest accrued. The balance does not shrink, it grows, slowly, imperceptibly, like a plant, growing in the darkness. After a few months, the cardholder receives a statement. The balance has grown to $2,000. The minimum payment has increased to $50, $60, $70. It is still manageable. The cardholder tells themselves, still reasonable. But there is unease, a discomfort, a sense that something is not right. Months pass. Another credit card offers a low interest rate, an introductory rate, for 6 months. The cardholder uses the new card to pay off part of the old card. It works. For 6 months, the new card has a lower interest rate, but after 6 months, the rate adjusts. It increases, often to 24%, 25%. Now, there are 2 cards, both charging high interest, and the cycle deepens. Years pass. There might be 3 cards, 4 cards, 5 cards. The cardholder is making minimum payments on all of them, but the balances are not decreasing. They are increasing, slowly, relentlessly. By the time reality sets in, the time when the cardholder truly acknowledges what has happened, there might be $30,000 in credit card debt, $40,000, $50,000. The minimum payments, combined, might be $800 a month, $900, $1,000. This becomes impossible to maintain, particularly if the cardholder has experienced a job loss, an illness, a divorce, or any of the 1,000 things that can reduce income. In these moments, some people turn to bankruptcy. They go to court. They declare that they cannot repay their debt, and the law offers some relief, some forgiveness. Their debts are discharged or reorganized. They get a fresh start, but the price is severe. The credit score is decimated, destroyed. Future borrowing becomes difficult, expensive. Mortgages become hard to obtain or require higher interest rate. Jobs. Some employers' check credit scores might become harder to find. Renting. Landlords might refuse to rent to someone with a bankruptcy on their record. It is a legal process. It is allowed, but it is painful, and it underscores a fundamental truth about credit card debt. Unlike a mortgage, which creates equity, which creates wealth, credit card debt generally only destroys wealth. It takes your money and converts it into interest payments. It is a trap, a well-designed trap, with attractive marketing and seductive rewards, but a trap. Nevertheless, step back for a moment, widen the lens, look at the entire landscape, not just one person, not just one cardholder, but the entire nation. America has a problem, a collective problem, with credit card debt. The statistics are staggering. The average American household carries between $8,000 and $9,000 in credit card debt. Some households carry much more: $20,000, $30,000, $50,000 in credit card debt alone, not counting student loans, not counting mortgages, not counting car loans, just credit card debt. Americans carry, collectively, nearly $1 trillion in credit card debt. 1 trillion, a number so large that it becomes abstract, unreal. But think about it. This is money that Americans have borrowed for consumption, for pleasure, for things that have generally decreased in value. Interest is being paid at rates of 15%, 20%, 25% every single year on this $1 trillion. That is $50 billion, $75 billion, $125 billion per year, flowing from American households to credit card companies as interest payments alone. This money could build schools, could rebuild infrastructure, could invest in innovation, could improve lives. Instead, it simply disappears into the corporate profits of credit card companies and the financial institutions that back them. How did America arrive at this point? Why is credit card debt so prevalent, so common, so accepted? Part of the answer lies in the marketing. Part of the answer lies in the ease, the ubiquity, the availability. Part of the answer lies in the culture. American culture is a consumer culture. It is built on the idea that happiness can be purchased, that joy can be bought, that identity can be expressed through the things you own, the clothes you wear, the car you drive, the vacations you take, the restaurants you frequent. Buying things is woven into the fabric of American life. It is not merely a transaction, it is an expression of selfhood. This is powerful. This is deeply ingrained, and the credit card is the perfect tool to enable this culture. It says, you can buy now, you can pay later, you can have what you want immediately, and this, in a culture built on consumption, is irresistible to many people. Add to this the anxiety, the insecurity that pervades modern life, the feeling that you must buy this product, wear this brand, visit this destination, or you will be less than, you will be lacking, you will miss out. This anxiety, this fear of missing out, is weaponized by marketers, by retailers, by credit card companies. They have discovered that people are more likely to spend, more likely to go into debt if they feel anxious, if they feel insecure, if they feel that they are missing something essential. And so, they cultivate these feelings, they feed them, they nurture them, all to drive higher consumption, higher debt, and ultimately, higher profits. If you were to visit a financial advisor or a loan officer at a bank, one of the first things they would ask you is about your debt-to-income ratio. This is a number, a metric, a way of measuring the relationship between the money you owe and the money you earn. It sounds technical, it sounds complicated, but it is actually quite simple. Your debt-to-income ratio, or DTI, is calculated by taking all of your monthly debt payments and dividing them by your gross monthly income. Let us say you earn $5,000 per month before taxes, and you have minimum monthly debt payments of $1,000, your student loans $200, your mortgage $800, your car loan $100, your credit card minimum $100, $1,000 divided by $5,000 equals 0.2 or 20%. This is your debt-to-income ratio. 20%. Banks and lenders have discovered through careful analysis, that people with a debt-to-income ratio below 28% are generally safe. They are likely to repay their debts, to make their payments on time. Between 28% and 36%, the risk increases slightly. Above 36%, the risk becomes significant. It becomes hard for a person to manage all of their debt, along with their other expenses, their food, their utilities, their insurance, their childcare. So most mortgage lenders will not approve a mortgage for someone with a debt-to-income ratio above 43% or sometimes 50%, depending on other factors. This metric, this ratio, reveals something important about the person. It tells you how much of their income is already committed, already allocated, already promised to debt repayment. If your ratio is very high, you have little flexibility, little room for unexpected expenses, for emergencies, for life. If something goes wrong, if you lose your job, if you get sick, if you need a car repair, you have no cushion, no safety net, no ability to absorb the shock. You are living on a knife's edge, one unexpected expense away from crisis. This is why financial advisors generally recommend keeping your debt-to-income ratio low, below 20%, ideally below 15%. If you can achieve this, you have room for unexpected expenses. You have breathing room. You can take a lower-paying job if you choose. If it makes you happier, you can take time off work to care for family, to handle emergencies. You have flexibility. You have freedom. And this is perhaps the most valuable thing that good debt and careful financial management can provide. Not just wealth, but freedom. The freedom to make choices. The freedom to live without constant anxiety, without constant fear that one bad month will upend everything. Consider, for a moment, how different America would be if debt were viewed differently, if debt were considered shameful, embarrassing, something to be avoided at all costs. In some cultures, this is the case. In some traditional societies, taking on debt is a serious matter, a source of shame, a marker of failure. A family will make enormous sacrifices, will go without, will deprive themselves of comfort rather than incur debt. But America has a different philosophy, a different cultural orientation. From the very beginning, America was built on borrowed money, on the belief that you could borrow today to create tomorrow, that you could take a risk, incur debt, and through hard work and industry, overcome that debt and build something better. This optimism, this hopefulness, has led to innovation, to risk-taking, to entrepreneurship, to the building of railroads and factories and businesses that have created tremendous wealth and opportunity. But it has also created a shadow side, a darker side, the belief that debt is normal, that going into debt is expected, that a person who does not owe money, who does not have a mortgage, who does not have student loans, who does not carry a credit card balance, is somehow unusual, perhaps even suspicious. This is reflected in the way credit scores are calculated. Your credit score is a number that supposedly measures your creditworthiness, your likelihood of repaying debt. But here is the paradox. If you do not borrow money, if you do not use credit, your credit score will be low or non-existent. This punishes the person who saves, who avoids debt, and rewards the person who borrows, who takes on debt. The system is designed to encourage borrowing, to encourage debt, because the financial industry makes money from debt. interest, fees, processing charges, all derived from debt, the system that supposedly measures financial responsibility actually penalizes those who avoid debt and rewards those who embrace it. This has profound implications for how Americans think about money, how they make decisions. When a young person reaches college age, they are told that they should borrow for education, that it is an investment, that everyone does it, that it is normal and expected. When a young person reaches the age of buying a home, they are told that they should borrow, that they should get a mortgage, that renting is wasting money, that home ownership requires debt. When a young person gets a credit card, they are told that it is essential, that they need it for emergencies, for building credit, for the rewards, and if they do not have a credit card, they are told that they are missing out, that they are not maximizing their benefits, that they are being foolish. So from every direction, from every institution, from every authority figure, young Americans are encouraged, are pushed, are nudged toward debt. And this cultural orientation, this collective value, this national attitude has become as fundamental to American identity as apple pie, or baseball, or the American dream itself. But it comes with consequences, it comes with cost, it comes with anxiety, and stress, and economic insecurity, for millions of people who are caught in cycles of debt that are difficult to escape. Now, we return to the fundamental question, the question that we began with, in the darkness, in the quiet moments, when you lie awake and wonder, is debt always bad? And the answer that has emerged from our exploration is no. Debt is not always bad. There is good debt. There is bad debt. The distinction is not arbitrary. It is not based on opinion or preference. It is based on economics, on the creation or destruction of wealth. Good debt is debt that enables you to build assets, to increase your future earning potential, to create wealth. Good debt is a tool, a vehicle, a means of accelerating your financial progress. Let us consider the example of a business owner who borrows money to start a business or to expand an existing business. The business owner might borrow $100,000 to purchase equipment, to renovate a storefront, to hire staff, to market the business. If the business succeeds, if the equipment is used to generate revenue, if the storefront attracts customers, if the staff provides services that people are willing to pay for, then the business will generate income, revenue, profit. The owner can use this profit to repay the debt and to build wealth. The debt was a tool, a means of accelerating the process. Without the debt, the business owner might have spent years saving, accumulating the $100,000. By then, the business opportunity might have passed, the market might have changed, the moment might have been lost. The debt allowed the owner to seize the opportunity, to act now instead of later. This is good debt. Now, consider another example. A person who borrows money to purchase shares of stock in an index fund, or a mutual fund, or an ETF. The interest rate on the borrowed money might be 5%. The historical return of the stock market over long periods is approximately 10% per year. So if you borrow at 5% and invest at 10%, you pocket the 5% difference year after year. This is good debt. It is called leveraging or using leverage. Professional investors do this all the time. They borrow At lower rates, they invest. At higher returns, and they build wealth. From the difference, of course, there is risk. If the market declines, if your investment returns less than 5%, you lose money. You lose the difference. So leverage works both ways. It amplifies gains, and it amplifies losses. But in general, over long periods, if you borrow at a lower rate and invest at a higher rate, you can build significant wealth. This is how wealthy people build and maintain their wealth. They do not simply work for wages. They borrow, they invest, they build assets that generate returns that exceed the cost of borrowing. Good debt is fundamentally about this. It is about borrowing money when the return on that money exceeds the cost of borrowing. It is about using leverage to accelerate wealth building. It is about understanding that the true cost of debt is not merely the interest rate, but the opportunity cost, the time cost, the ability to move forward now, rather than waiting to accumulate resources later. This is the wisdom that separates the wealthy from those who remain in debt. The wealthy use debt strategically. The poor and the middle class often use debt reactively to manage crises, to cover expenses, to fill gaps. This difference, this fundamental difference in how debt is used, is perhaps the most important distinction in understanding how wealth is built and how it is lost. If you are listening to this and you find yourself carrying debt, perhaps quite a lot of debt, perhaps more debt than you would like, there are strategies, there are approaches that can help. They will not solve everything, they will not provide miracles, but they can provide direction, relief, a path forward. The first strategy is the simplest, but often the hardest. Stop accumulating new debt. This sounds obvious, but it is not easy. It requires discipline. It requires the ability to say no, to delay, to wait, to postpone purchases, to live without, to be comfortable with discomfort, with delay. But it is essential. You cannot build wealth if you are simultaneously accumulating new debt. It is like filling a bathtub while the drain is open. The water might reach certain levels, but it will never fill. Not while the drain is open. The first step is to close the drain. Stop adding new debt. The second strategy is to develop a budget or a spending plan to understand precisely where your money goes every month. Many people do not know they spend money mindlessly, without intention, without awareness. They buy coffee, they subscribe to services, they purchase items on impulse, and at the end of the month, the money is gone. If you can create a detailed budget, if you can understand every dollar that comes in and every dollar that goes out, you can make informed choices. You can find areas of savings. You can redirect those savings toward debt repayment. The third strategy is to prioritize which debt to pay off first. There are different approaches. The snowball method, paying off the smallest debt first, then rolling the payment into the next debt. This provides psychological wins, quick victories that motivate you to continue. The avalanche method, paying off the debt with the highest interest rate first. This is more mathematically efficient. It saves you the most money. Choose whichever aligns with your personality, with your motivations. Both work. The fourth strategy is to increase your income. You can pay down debt faster by earning more. This might mean asking for a raise, finding a better job, starting a side business, freelancing, finding any way to increase the money coming in. Every dollar of additional income can be directed toward debt reduction. The fifth strategy is to consider negotiating with creditors. If you are struggling, if you cannot make payments, many creditors will work with you. They would rather receive some payment, some reduction, than take you to court or force bankruptcy. They might reduce your interest rate. They might extend your payment period. They might accept a lump sum settlement for less than the full amount. It never hurts to ask, to negotiate. The sixth strategy is to educate yourself, to understand deeply how money works, how compound interest works, both in your favor and against you, how inflation affects your debt, how the economy works. This knowledge, this understanding, will inform better choices, better decisions, and will protect you from being exploited or misled by financial institutions. Understanding is power. Financial understanding is financial power. These strategies are not glamorous. They will not make you rich overnight, but they provide a path. They provide direction. They provide hope that the debt, the burden, can be reduced, can be managed, can eventually be eliminated. We have traveled together through centuries of history, through the development of financial systems, through the stories of individuals and families and nations. We have explored the distinction between good debt and bad debt, and we arrive now at the final question, the question that perhaps matters most. How do you, how do I, how does anyone build wealth wisely? And the answer is this: wealth is not built by avoiding debt entirely, though that would be ideal. Wealth is built by understanding the difference between debt that builds and debt that destroys. Wealth is built by borrowing strategically when the investment exceeds the cost. For a mortgage on a house that will increase in value, this is often a good choice. For an education that will increase your earning potential, this is often a good choice. For a business that will generate revenue and profit, this is often a good choice. For a credit card, for consumption, for things that decrease in value, this is rarely a good choice. Wealth is built by living below your means, by spending less than you earn, by directing the difference toward assets, toward investments, toward things that generate future returns, not toward consumption, not toward pleasure, not toward things that fade and disappear. Wealth is built slowly, methodically, over decades, through the power of compound interest and compound returns. When you invest $10,000 at 10% return, in the first year, you earn $1,000. In the second year, you earn $1,100. The return has compounded. It is working for you, not against you. Over decades, this compounds dramatically. A person who invests $10,000 per year for 30 years at 10% return will have over $1.5 million, not from their own money, but from the returns generated by that money. This is the power of compound interest. This is how wealth is truly built, not through high income, though high income help, but through consistent, small investments over long periods. Wealth is built by minimizing debt that destroys wealth, by avoiding credit card debt, by avoiding debt that is taken on for consumption, by developing discipline, by developing patience, by understanding That delayed gratification is not punishment, but investment. Wealth is built by educating yourself, by understanding how money works, by understanding how financial systems work, by not being afraid of financial concept and numbers and mathematics. Knowledge is protection. Knowledge is power. Wealth is built by working, by providing value, by creating products or services that people are willing to pay for, by solving problems, by meeting needs, by contributing to your family, to your community, to your society. Work is not punishment. Work is the vehicle through which wealth is created. Finally, wealth is built by maintaining perspective, by understanding that money is a tool, not an end, not a goal, not an identity. Money is a tool, a means through which you can build the life you want to live. Money provides security. Money provides options. Money provides freedom. But money alone does not provide happiness, does not provide purpose, does not provide meaning. Purpose and meaning must come from within, from your relationships, from your work, from your contribution, from your values. So as this journey comes to its end, as you drift deeper into sleep, consider the debts in your own life. Consider whether they are serving you. Consider whether they are building or destroying. Consider what changes you might make, what investments you might prioritize, what new habits you might develop, and perhaps most importantly, consider whether you might choose to quietly subscribe to this channel so we can explore other forgotten paths, other forgotten wisdom about finance, about economics, about the building of wealth and the creation of a life well lived. Thank you for sharing this time, this darkness, this quiet moment before sleep, for listening, for thinking, for considering, for allowing your mind to drift through these waters of financial history and financial wisdom. May you sleep well, may you wake refreshed, and may you build the wealth that you deserve, slowly, methodically, wisely, over time. Good night.